people love to think in binary terms. They either want to think I'm in or I'm out, and the easiest way to tell them is say, "Hey, look, sell half." Now they hate that advice, and often they won't take it. But we say going halvesies is a pretty good advice because it breaks sort of the emotional tie to a potential outcome. Now they hate it because they can't cheer for whatever outcome and have the hindsight regret or bias about what they shoulda, coulda, woulda done.
Welcome to the Advisors Fuel podcast, where high-performing financial planners and wealth advisors discover proven processes and actionable strategies to elevate their client experience, grow their businesses faster, and achieve unprecedented success. Here's your host, Adam Koch, founder at Adrenaline Advisor Consulting at adrenalineadvisor.com.
All right, well, Meb and I had a little bit too much fun because before we knew it, the first part of the recording that wasn't even supposed to be a first part at all ended up lasting way longer than we thought. So we ended up deciding to split it up into two pieces. So sit back, relax, and enjoy part 2 of my discussion with Meb Faber. Okay, everybody, I know we didn't plan on this being a 2-part episode, and I'm not sure if the marketing people are going to turn this into a 2-part podcast or it's going to be one big long podcast, but I've got Meb Faber again here. We had a great conversation last time. I'm extremely long-winded, and so it's probably mostly my fault, but I've got more questions today, and he's been kind enough to spend some more time with us today. So we were just talking offline, and I'm going to go backwards here in a second to my other question, but we were just talking offline about home country bias, and Meb was talking about how he probably talks about home country bias more than anybody in the world, and that you could just type in Meb Faber home country bias and you'd find 100+ articles, podcast material. And by the way, I would encourage you to do that, by the way, because this is good stuff, and I think it would probably save everybody a whole lot of heartache when you're looking to outperform the market. You know, some of the time, all the time doesn't make a difference. But Meb, talk a little bit about home country bias. Tell people what that means, what your opinion is.
Home country bias is the simple phenomenon where most of us, really all of us around the world, in terms of aggregate countries, invest most of our money in our own country. So if you're American, you put most of your money in the U.S. stock market. That's true for our friends in Japan and the UK and Brazil and Russia and China and on and on. And it's a really terrible idea. It's a terrible idea because, countries on average compared to a global portfolio, could be market cap weight, could be equal weight, have much worse returns in terms of risk-adjusted returns. You get a better diversified portfolio, but also you can go very long periods underperforming. You may get lucky. Maybe you bet on South Africa and Australia this past century. Maybe you got unlucky and bet on things like Austria or Japan for various periods, Germany, God forbid, Russia and China, in which case the governments decided, we're going to shut down the capital markets, and they went to zero. So diversification globally is a no-brainer idea. It's also a no-brainer idea just in terms of breadth. You have more choices. There's more stocks outside the U.S., and there's a lot of coping mechanisms and reasons people give to only invest in the United States, all of which are terrible, and we've been through many of these over time. But in general, the world is our oyster. And not only that, geography and borders are becoming increasingly meaningless. You could have a stock that's listed in the U.S. and has no U.S. revenue. Things like that complicate it. Added on additionally to the current situation where U.S. stocks are much more on aggregate market cap weighted, more expensive than a lot of other countries, the rest of the world. It's a situation where it's becoming apparent this year, where foreign stocks are rocking and rolling. But in general, it's not just true on a country level; it's true on a regional level. So if you live in the Northeast, you mostly buy your overweight financials. If you live in Texas, you guys can guess it. What are you overweight? Energy. My home state, California. Again, you can guess it again. Overweight tech, on and on. So it's sort of a crazy situation, but it's not one that is rewarded.
So if I live in in Australia or Singapore, all I have to do to beat the stock market is just buy U.S. stocks for 15 years, right?
Yeah, it's funny. It's an even worse situation ex-U.S. U.S. is 2/3 of the world market cap. So if you invest all your money in the U.S., it's not as big of a bias as it is if you invest in, Malaysia and put 98% in, because the world market cap in Malaysia is like 0.5% or something. So to diversify globally, people love to give me a hard time for the last 15 years because they say, Meb, U.S. stocks have crushed everything. Therefore, you're wrong about home country bias. I say, what are you talking about? I've been right in 44 out of 45 countries. I think that's a great track record. It's just one. If you ask someone in, Russia, China, UK, Brazil, if investing globally was a great idea the last 15 years, they would say, hell yeah, it is. It's largely because I invested in the U.S. But, the prior decade was the exact opposite of that, too.
I mean, I look at when I talk to clients about stuff like this, we talk about how we handedly outperformed between 2003 and 2008 because of the fact that all you had to do is invest outside the U.S. And I'll never forget this architectural engineer client who, at one point, I think it was like 2005 or 2006, he says, "Hey, Adam, don't you think we should probably change the index to the ACWX now, or the like the XUS index, because since we're so heavily weighted overseas?" And I'm thinking, man, I can't win, you know. But what are your thoughts about
Yeah.
U.S. versus international? We've had a few blips, I'll call it, the last decade or more, 15 years, really, more than that. What do you think? What do you think's coming? Do you think that's going to be one of those things where the pendulum's gonna swing the other way soon? Obviously, we're not trying to confuse here, right?
Yeah, I mean, this is does not get me invited back on TV, but it's what I do say when people ask like this question. I say, look, there's a future spectrum of probabilities when it comes to markets. It's like sitting down at the blackjack table. It's like, what's the most likely outcome? You're sitting on 20, and the dealer's got a 6. You're probably going to win that, right? But dealer flips a 5 and a 10, you lose. And so there's probabilities and outcomes. And so the probabilities in my mind, when a market's as expensive as the US is currently, the most likely outcome is subdued returns for the next 10 years in the US for buying the S&P 500. Doesn't mean it has to crash, doesn't mean it has to go down 80, doesn't mean it can't keep going up, right? This is all driven by humans, and there's been other times when valuations have been higher in plenty of other countries than in the U.S. currently, and the biggest one we always talk about is Japan in the 1980s, which is probably a double from here. So imagine that, the U.S. stock market doubling from here. But if I had to guess, it would simply be a reversion where foreign developed and emerging catch up, small caps catch up. They've done very poorly relative to large, ditto for mid. And maybe the large stuff in the US kind of flatlines or just doesn't do 15% a year. Maybe it does 7 or 5 or 2. And so I think the big variable challenge, of course, is inflation. That's the key leveler on what's happening, because a 10% return with 10% inflation is totally different than a 10% return with 2% inflation. So my best guess is that foreign, developed, and emerging do much better. I think value trade. Here's a stat for you. We may have mentioned this in the first half. I can't remember, it's so long ago. But by the end of September, people say value hasn't worked. Value hasn't been working. It's working, just not as it's working outside the U.S.
Hmm.
And so a portfolio of deep value stocks, and we have an ETF that does this. This is GVAL. Everyone would say, man, the US stock market has just been on fire the last 1, 3, 5 years. It's crushed everything, NVIDIA to the moon, yada, yada. This deep value strategy will be beating the S&P over the last 1, 3, and 5 years.
Wow.
Which is crazy to think about because no one's talking about it really.
Oh.
So if you look at the value strategies in the US, value strategies, foreign, developed, emerging, and globally, a lot of these are up 25, 30. The one I'm referencing is up well over 40% this year.
Wow.
But it's quiet and it's underneath the surface because the US is an all-time high and doing well. So there's a lot of different outcomes, but in general, being diversified to me, I think foreign's got a long way to do some catch up versus the US.
Yeah, you mentioned small caps, so speaking of small caps, that's another one that you mentioned earlier, that gold is one of those things that kind of did nothing for a really long time. You mentioned Japan was in the same boat for a while. Kind of, I don't want to say still is, but when you look at small caps, it's a long time that small caps just went through a period of not hitting an all-time high, and we'll see whether or not this one proves to be strong or not. But kind of like you, I agree. I always say I'm a trend follower, not a trend predictor. But I think that's probably, when you look at a year where, in a post-election year, month of August is supposed to be one of the worst months. September is supposed to be the worst month. And at least so far, we're recording this today on September 22nd. At least so far, I mean, things don't look so bad, which between that, small caps breaking out to all-time highs, that's probably not a bad thing for the market overall.
We did a series on the blog called 20 Things You May Not Know About Markets, one of which was like just how long an asset can go underperforming. And even the premier asset, the best asset in the world that everyone owns, U.S. stocks, there's been times when it underperforms bonds for decades, right? Think about that. Not just a quarter or two or a year or two, but decades or no return. And so, that's a lot longer than most would ever consider. And I think that's true for styles and geographies, things like small caps and mid caps. There's times when they look amazing and times when they don't so much. And they go through these periods. And this is certainly, if you look at sort of the Venn diagram overlap of small caps and value, basically anything other than market cap weight. I mean, we're doing this on a day when Nvidia's up another 4%. So maybe the world's first $1 trillion company. We'll see. I mean, 10 trillion, excuse me, not 1 trillion. We'll never know. But yeah, it's these. Everything has its season. I feel like is kind of the theme of what we've been talking about, and that's true with small caps too.
You mentioned in part one, every investment makes you richer or wiser, but never both. A couple of my technician friends like to call these lessons that make us wiser when we lose, especially they call it tuition. But how would you leverage the wiser outcome when, let's just say, a model isn't how everyone would like it to perform at any given time, let alone all the time?
I think everyone, really would prefer not to have to go through the wiser part. It's painful, the losers, but it's part of the game. And, we all have them. The older we get, I feel like the less they hurt. I think the older you get, the less game-changing losses we try to take as traders and investors. You try to avoid the ones that are going to take you out of the game, the minus 100%ers if we can help it, or if there is something that potentially could go down minus 100, you portfolio size it so it's small enough that it's not going to matter. But it's the reality of it. I don't know what you learn from your winners other than you get to go tell your neighbor and brag about buying this hot stock or this coin or whatever it is. But I think that's what drives a lot of the fear and greed and FOMO, the big one in markets. Nothing worse than your neighbor getting rich and you not, whatever that investment may be, whether it's Bitcoin, whether it's Nvidia, whether it's, in past lives, the bricks or options or who knows what. But I think there's a lot to learn from the losers. Certainly, for a long time on our podcast, we would say, what's been your most memorable investment? A lot of investors respond with losers or painful trades they made that, they said, hey, I'm never going to do that dumb shit again. Like, I can't believe I did that. I learned my lesson. And so, I think a lot of people want to avoid the losers, but that's the reality of it, of our world. That's part of the tuition. It's part of the toll.
You mentioned offline. I can't remember who you said originated the idea, but when you talk about, batting average, hit rate, one of the things I'd like to tell our clients is that, if in Major League Baseball, when you can hit the ball 3 out of 10 times, you get invited to the All-Star game typically. But in this game, it's different, or at least the assumptions are different. And I can't remember who you mentioned, but you mentioned, I don't want to call it an analogy, but a story about, a really, really profitable trading system, but people might not be so happy about it. Can you talk about that?
Yeah. So James Altucher, in one of his first books, was talking about some trading systems. And he said, look, I can come up with a trading system that has like a 99% accuracy. And so everyone, ears perk up. Ooh, like what's this secret indicator? What is this? And he goes, it's actually really simple. You buy an investment. Doesn't even matter what the entry criteria is. Could be random even. Let's say it's a stock and I buy it today. My exit criteria is first profitable close. So if I buy Nvidia at 180 and today it closes at 183, I'm out. I made a profit. And so a lot of people are attracted to these type of systems. But on the expected value for these type of systems, the problem is you're holding it. So maybe you just bought the top in Nvidia and it closed today at 178 and then tomorrow 175 and then 170 and maybe it gets disrupted by China or some other entrepreneur in a garage. Next thing you know, Nvidia's at $10. And so you've lost 90, soon to be 100% on an investment. So yes, you may be the classic phrase of picking up, pennies or nickels in front of a steamroller. And on the flip side is something like trend following, where often you have a low batting average. Some of these trend following systems are less than half, but the gains are so much bigger than the losses. You take all these small little losses, for many who'd call them stop losses, but the gains sometimes can be doubles, triples, 10 baggers, where you own something like the euro dollar or gold or something, and you may own it for a few years. And so getting that, I mean, it's the same is true with the casino, same is true with anywhere you're betting, where you come up with the formula, the expected value is, what is your hit rate, but what is the win rate when you hit? How big are the wins relative to the losers? And so many people are attracted. They want the first system. They want high certainty, but in a world, it's like selling options. Selling options, that type of idea often can be that sort of payout where you're right most of the time, and then when you're wrong big. So
Right.
trying to figure that out, I think, is a big lesson.
What you said reminds me of a story back in summer of 2024, I think it was, June, I think it was, where back in 2022, November, we got out of the bond market completely. We just completely stayed out of bonds. And I decided that it looked like a good setup to get into a couple different bond positions in our fixed income sleeves in I think it was June of 2024. And my stop was somewhere in the ballpark of 1.2, 1.1% below the entry, and they all stopped out. And I totally forgot about who I was talking to, because I was talking to a client and not someone like you. And I uttered the words, you know, we put this entry in place at 1.2%. We got out. We ended up being down like 1.3. It was a great loss. And they looked at me with this sideways, like just this curiosity, but at the same time anger. Like, what do you mean a good loss? They literally said to me with this angry voice, what do you mean a good loss? There's no such thing as a good loss. I'm like, wait a minute, there is such thing as a good loss. I mean, in a trading
Yeah.
system anyway.
Yeah, you can, and also there's a nice cleansing feeling of moving on. So many people, the analogy we always give is baggage on their investments, and it's easy to relate this because we place a different emotional, psychological value on something we own than something we don't. And y'all don't believe me? Walk on out to your garage, walk on into your closet, and imagine if there was a flood and everything was destroyed in your closet or garage, and you got that check in the mail. Would you go buy all the stuff again? Like, of course not. Like, there's no scenario, but it's just a bunch of garbage and junk that you're unwilling to get rid of. And it's true with investing portfolios. I mean, how many of these legacy funds and stocks, if you said, all right, my brokerage account, I got to start over, would you buy the same ones you own? Of course not. And so people, I think, apply that lens to their investments as well. And so it's a very cleansing feeling to be able to say, okay, I can start from scratch. And a lot of people, when you've sold an investment, it's great because you can just move on to the next one. Like it's like starting a new day. The problem is when you're holding something, and traditionally that's for losers, but it can apply to winners too. It's really hard to become distant. So we, tell people, hey, write down what's going to be your exit criteria for this investment. Most people don't do that. They just buy something and wing it. See how it goes. That's the phrase. All right, we're going to buy this and we'll see how it goes. Well, what if it goes down? What if it underperforms for years? What if it goes up a lot? That's equally as challenging, And so I don't think people really consider that for the most part.
I love the flood in the garage, flood in the basement, flood in the closet analogy. I'm pretty good at analogies, but I think you might beat me. That's great, and I feel like that comes up so often too with investors. The whole I'm holding on to this stuff, I don't want to get rid of it. Whether it's a winner or a loser, it's just different psychology.
And also, like, people love to think in binary terms. They either want to think I'm in or I'm out, and the easiest way to tell them is say, "Hey, look, sell half." Now they hate that advice, and often they won't take it. But we say going halvesies is a pretty good advice because it breaks sort of the emotional tie to a potential outcome. Now they hate it because they can't cheer for whatever outcome and have the hindsight regret or bias about what they shoulda, coulda, woulda done.
It just made me think this morning. I was getting ready this morning, and I'm not sure if it's in the DSMV yet, but there is a new, I don't want to call it a diagnosis, but personality type. There's introverts and extroverts. Speaking of binary, apparently now there's otroverts who are not extroverts or introverts, apparently. So anyway, you can look it up later.
All right.
We're talking about one of the things that I teach financial advisors in my coaching program, Adrenaline, is it's the clients don't want to hear about alpha, beta, Sharpe ratios, correlation coefficients. So I'm curious, what would you say separates financial advisors that really connect with their clients from those who get lost in all the technical talk and jargon?
I think that's all of it. I think coming up with, I think uh, a narrative. Uncle Warren's really good about this. He sounds very folksy. If you're on the other side of any of these trades, he's going to rip your face off. Like he's not a person you want to be negotiating against. But he's learned how to put this all into a narrative. Jack Bogle was great at this at Vanguard. Coming up with your go-to 10 stories or phrases or quotes when someone asks you a question, put them into almost like a miniature book. And it's like Buffett is like, you could push a button. It's like, someone's going to ask this question. You know what he's going to say. He's just like, ding, cue up this story and quote. But there's a reason, is because it works. You tell the story and people are like, oh, they nod their head. They're like, okay, I get it. That makes sense. And I think the same is true because look, we don't teach financial education in high school. And so people don't have the tools. And then it becomes emotional most often. And this is changing a little bit. I think our generation, our parents are a little bit better than this than kind of the Depression era parents. But it used to be no one talked about money. It was considered rude or classless. It's not something you talk about. But then you get into a scenario where no one knows what the hell they're doing. They don't understand money. And so, and we know anything about relationships, it's often the number one most stressful topic for people, and personal finance, not just investing. So, I think I think coming up with narratives and storytelling, that's kind of the job of the investor advisor, is to relate it to people so that they can understand it. No one gives a damn about Sharpe ratios. They just want to say, "Am I going to be all right? Are you going to lose all my money or what?" The problem on that, of course, is the flip side too, where it's easy to seduce people and sell them and swindle them because they don't have the base case to say 50% returns. That sounds pretty good. I should do that. And 40% yields. Sure, like that. Why wouldn't I do that with all my money? But that's sort of the challenge we have as an industry, is cleaning up the garbage too.
Yeah. So stories like the flood story you told, just helping people come to realizations that make sense for them, but pretending like everything you do is going to be in tomorrow's front page too. I think, you know, wow. Investors should look for fiduciaries, in my opinion. I think that's the first thing they need to do in order to make sure that they're not going to be taken advantage of. But how can advisors use your frameworks? I mean, I've been following you for a long, long time, but shareholder yield, tactical ETFs, to basically build portfolios that are better, and more importantly, maybe explain the strategies to clients in a ways that you're not just buying the index and that's it.
Yeah, I mean, look, it's the best time ever to be an investor, and I think it's there's a lot of great choices out there, and actually, you could do totally fine not using our funds and strategies. But as an investor, I'll tell you that the main three mistakes that we see consistently from not just individuals but also professionals, and a lot of people don't agree with this. So, listeners, feel free to shake your head. The first one is that home country bias. Almost every portfolio we see is chock full loaded with only U.S. stocks and bonds. Number two is most portfolios don't have any exposure to real assets. I actually tweeted about this today. We have an old book called Global Asset Allocation. It's actually free online. This sucker's 10 years old now. So we got to write an update in the first quarter of next year. But we looked at all the most famous portfolios from gurus and advisors, risk parity, permanent portfolio, endowment style, portfolios recommended by Buffett and others. And the most consistent portfolios across the 70s, 80s, 90s, 2000, 2010 always had one characteristic, was that they had a decent exposure to real assets. And what do I mean by that? So there's stocks, there's bonds, and real assets are things like commodities like gold is a big one. Things like real estate investment trusts, so commercial property, REITs, we call them. Things like TIPS, treasury inflation protected securities, but gold being a big one. And I think people, may have laughed or scoffed at me saying that a couple of years ago, and maybe as gold approaches 4,000, not laughing so much. But if the only portfolios that had positive, real after inflation returns since the 1970s included a decent chunk to real assets. So very consistent portfolios. Um, and then lastly, once you've done those things, and of course the table stakes are you should do this with a mind on low fees and taxes. Taxes are really important. So we obviously use ETFs, which we think are a massive innovation in the investing world. And the last one is I think you can add tilts towards things like value. I think value is a better way to express investing in stocks than market cap weighting. And then the second is things like trend. And trend is probably the biggest departure from most traditional portfolios. But once you have that buy and hold, globally diversified portfolio with real assets and tilts to value, the problem with that portfolio, its Achilles heel, are the big crisis drawdown events, things like the Great Depression, the global financial crisis, even the post 2000 internet bubble burst. Because as a buy and hold investor, you just have to take it. You have to do nothing, say, look, I'm just going to ride this out. And for many people, losing 20, 40%, 50% is really hard. You know, a lot of times people in '09, they sell everything and say, I can't take anymore. I can't afford to lose any more money on this portfolio because I won't be able to take care of my moms and my kids at college, whatever. And they sell and they never invest again. So trend following doesn't have that weakness traditionally. Trend following traditionally does well during the really long, bad, nasty bear markets. The struggle with trend is always twofold. It's one is you look different at other times. So post 2010 through I don't know 2020, you know, you may not look as good as the S&P just printing 15% a year. And the other, I think, is implementation, though that's changed. I think there's probably a dozen ETFs, maybe 20 now that do various forms of trend that you could allocate to a portfolio. And I think there's no better premier diversifier to a traditional buy and hold than trend strategies overall. So that was a long-winded answer to what we're talking about, but I think coming up with a robust portfolio. But if you came to me and you said, hey, Meb, you know what? Look, I just buy 20 dividend stocks per year. I rebalance and I call it a day. I'd say there's worse things to do. As long as you can sit through that and you know the downsides and the weaknesses of that portfolio, God bless you. Great. Good on you.
I can't remember if we talked about this last time, but I think that you have to be somewhere in the ballpark. And we probably did, and if so, I'll ask my producer to cut it out. But I think you have to be somewhere in the ballpark of 46 years of age, 45 years of age, to where you would have experienced an actual bear market when you had money. So for someone to experience a real crash, not 2022, not COVID, where the market comes back, almost right away. You mentioned the 2010s, or 20 teens, whatever you want to call it, where the market looks like it's going to crash. Tornado sirens go off, but there's no tornado. 4 months later, we're back to where we started. But I feel like most people don't really care about their 401k if they're 25, 26, 28, because there's not enough money in it yet. So when you look at the math between when people were born and how old they are today, you'd have to be in your 40s before you'd really understand what it's like to even remotely understand the feeling of living through a real market crash, like a double digit, 40, 50% drop. Wouldn't you agree with that?
I think the struggle for people trying to empathize with their older self anyway is like, all right, you're a 20-year-old. And I gave a speech once at Trinity College in Ireland. And I said, look, a lot of y'all are about to go on spring break or whatever the finals break was called. And I said, you can, for them, it was Ibiza. Here, I would say Cancun or something. I don't know. Say you can go to Ibiza and spend $1,000, probably 10,000 today. I don't even know. Or you could say, you know what, I'm going to go backpack somewhere and not spend that money. Let's use 10,000 because it's a better example. In 25 years, that 10,000, if you put it in investing markets that do 10% a year, that's worth 100 grand. In 50 years, so when you retire at 70, they're probably not retiring at 70. They're probably going to live to 150. But let's say you're 70, you now got $1 million and you didn't do anything. You literally just put it in a lockbox, said, goodbye, sweet prince, just go compound. And it does. However, most of us want to go to Ibiza or Cancun, and it's also like it might be worth it. You may meet your future spouse, it may be a lifetime of memories, but it's that constant push pull. Buffett used to talk about this a lot. Is he actually said it was a struggle for him because he would say, "Well, I can buy this car," but in my head, what I'm compounding at, which is like double what I'm talking about. He's like, "That's not a 10,000 car. That's like $1 million car."
Right.
And can I do without it and compound? But at some point, you also have to live. You got to live this life, but I think being mindful of that at least puts some of our dumb purchases into perspective and say, do I really need that F-150, or should I maybe buy a cheaper car and be able to buy 4 of them in 10 years? I don't know.
Yeah, I don't mean to sound like a doom and gloomer, but the reason I was bringing that up, the whole age thing, is because I feel like it's not to pick on younger people, but it's to say that when you talk about the 2010s, even into this decade, with the exception of COVID, there's this perception, I think, amongst most investors that things do just come back 3 or 4 months later. And living through a big market crash, which I've done now in my career twice, if you include the dot-com bubble and the mortgage crisis, and I know you have too. It's very different than a quick 3 month, turn your head away, throw the statements in the fire. When 6 months later it's still going down, and 9 months later it's still going down, and 12 months later it's still going down. So I guess I just feel like that's where I wish that there were more people, including professionals, that were more open minded to more tactical approaches and diversifying by strategy, as opposed to just diversifying by asset class, sector, and sticking with the buy and hold, not Monte Carlo, sorry, modern portfolio theory, which in my opinion only works in up markets anyway.
Yeah. Well, nothing like a nice long fat bear market to wash that out of everybody's system.
How could where do you think financial advisors' advice should evolve? Should they lean deeper into behavioral coaching over traditional technical expertise in Monte
I
Carlos?
mean, Betterment, our friends at Betterment had a funny example back in the day where they said, there's the market was volatile or it went down a bunch or something happened. And they said, all right, we're going to send out this email to tell everyone, hey, look, don't panic. Just, I'm letting you know, markets are volatile. This is okay. It happens. And they said about half the people are like, okay, great. Thank you for sending this to me. I'm good. And the other half are like, wait, I haven't been watching. The markets are volatile, like they're crashing. Like what's happening? Like I don't want you to send this to me. Like, so like different people react differently. And so we've long said the benefit of financial advisor, and sorry, advisors, if you're listening to this, is not on the asset management side. I think that's sort of table stakes today. I don't want to say investing has been solved, but you can put together a 80%, 90% of the way portfolio there on a note card, or even buy. We have 3, 4 all-in-one kind of asset allocation ETFs, and frankly, you could just buy that ETF and call it a day. But where is the real big value add? It's making sure that people's taxes are done right. It's estate planning. It's making sure they have insurance if they need it. It's behavioral coaching, which you talk about, not keeping them from doing really dumb stuff, on and on. And a lot of those, I mean, the tax part alone, the decision to be in ETFs rather than tax inefficient mutual funds or really expensive other investments is multiple percentage points of difference per year. So maybe like the investing is usually the fun, sexy, exciting part, but I think all those other inputs can be equally, if not more important, to the end investor.
I would argue that more advisors would experience more growth and help more people save more people from bad advice and bad advisors if they would focus on that part instead of nerding out, on all the details. But you've inspired so many advisors and thinkers in our industry over the years, me being one of them. What's maybe one question that or view that you wish people would ask you more often? I mean, you write a lot of articles, you're on a podcast a lot. Maybe it's one question that rarely comes up, but reveals something core to what you do or what you believe that people just don't ask enough.
That's good. I have a lot of non-consensus views. We have a rolling Twitter thread called "Things I Believe That 75% of my professional peers don't believe," and it's like well into the 20s now.
A great font, by
Um,
the way.
yeah, I mean, I'm not making a lot of friends, but one of them is that it doesn't have to be complex. A lot of investors assume the more work they put in, the more complexity, the harder they try, affects the outcome. And that's true for most professions. It's true for most of the world. It's not necessarily true in investing. And, like you said, you could buy, like, I love to pick on CalPERS and Harvard and some of these giant institutions with limitless resources. But the reality is most of them can't outperform a basic buy and hold of various ETFs. And they don't like to hear that, but it at least has been true. And we now have an endowment style ETF, so they can compare it to this investable benchmark going forward, which will be fun to watch. Um, but I think I think that's a big one. I think taxes to me have been a big part of this. Is a lot easier alpha. We've been rolling out these 351 ETF exchanges to help solve concentrated stock positions, which to me, a lot of people out there say they got a ton of money stuck in stocks, and they say, look, I know they're expensive, I don't want them, but the tax man's going to kill me if I sell them. This is a potential solution for those type of situations. And I think the tax alpha is a lot easier than the investment alpha, avoiding paying large checks to Uncle Sam. Who doesn't love that?
Yeah, seriously. Well, before we close, you're doing a lot over at Cambria. You've got a lot to offer financial advisors and the retail investor alike. What resources would you like to highlight, or any upcoming projects you'd like advisors to know about? You just mentioned highly concentrated stocks. I was actually going to bring that up, but since you brought it up anyway, anything else?
Yeah. So if you want to learn more, you can go to Cambria Funds. We got a little tab called 351, which you can learn about. We do webinars and podcasts. We got all sorts of material on that. It's a pretty cool idea. Other things, we're going to soon launch Fund 19 and 20. So we got a little bit of something for everyone. Our goal is to try to only launch funds that don't exist and that we want to put our own money into. So sometimes they're a little weird and different and concentrated, but to me, that's kind of the whole point. So we got a lot of literature on there, and of course, find us jabbering away on the podcast. I think 600 episodes now and thousands of blog posts. And the Idea Farm, which is my research service, that's free. We get a once a week email on Sundays that I think is a good treasure trove. I don't write it anymore, so I can compliment it and say it's really great. And one of my favorite things on Sunday morning, coffee. Because I'm on the West Coast, football and Barron's and the Idea Farm is my go-to morning.
All right. Well, if you want to connect with Meb, we're going to put all his contact information in the show notes. But I was going to mention the Idea Farm. I subscribe. It's awesome. It's really easy to just kind of skim through it, find maybe a couple research articles that look interesting to you. Check out the Meb Faber Show. So mebfabershow.com. It's also on YouTube. Cambria Investments is the website. You can also check out Meb's blog at mebfaber.com. Find him on X and find God, what's it called again? The Things I Believe, right?
Yeah.
Yeah, check that out and follow. It's hilarious. Well, I shouldn't say hilarious. The reactions are hilarious. How's that? But there's more ways to contact him. And if you're looking for ETFs, I'm glad you mentioned, Meb, the whole idea of something being, whenever you start something, it's always something new and different, because I get solicited from companies literally on a weekly basis with an ETF idea or investment idea. And what I always tell them is I have inventories for each asset class. And one of the first things I do twice a year is look for something that's not correlated to what I already own. And if it's already correlated, then chances are I'm probably not going to put it in the inventory. So really cool that you guys do such different work, and that, you're really pushing the word about, technical analysis and tactical portfolios, which I love. So thank you so much for being on the show. I really appreciate it.
It's been a blast. Thanks for having me.
Yeah. Well, as I always say, there's thousands and thousands of podcasts out there. You chose to give ours a listen today. So thank you so much for joining us, and we'll see you next time.
Thank you for tuning in to the Advisors Fuel podcast. For more articles, videos, and resources, or to schedule an intro call, visit adrenalineadvisor.com. This podcast is for informational purposes only and should not be relied upon as a basis for financial or legal advice. Always talk to your compliance department before implementing any of the ideas shared in this episode.